All right, so recording's live. So this is for future questions. For those of you guys who have been questioning about what a redelivery balance is, what I'm going to do is I'm going to break everything down to a fundamental perspective and describe the types of redelivery balances. Now, with my presentations, I'm not just describing what they look like, okay? And that's why I like to tell people my own style of education is different from the next person's style of education because my job, uh, this was where I learned how to trade. My way of understanding price is to understand why something should happen, and I think that's a better approach to understanding concepts. Okay, understanding the why, because if you can understand why something should happen, then you can know when it's most likely not to happen and when it's most likely to happen, versus the other styles of you being taught whereby you understand what is happening, okay, or how it is forming. That's different because then you don't know when it's likely to work, when it's not likely to work, because there's no context behind the understanding of what you're learning. So that's why when I do special presentations like this, I have to break everything down to the fundamental standpoint so you understand and you can see them form. So you'll be able to see these type of price action form before it actually forms, and that's the goal of the presentation. So yeah, it's being recorded. So hopefully you guys enjoy the presentation, and then after we're done, I might go live for London Flows if there's something interesting for me. With that being said, let's get into this. Now, what is a fair value gap? What is an inefficiency? Okay, that's the first thing. That's what you need to understand first off. Why are they significant in price? Why are inefficiencies significant in price? Why are fair value gaps significant in price? Why are volume imbalances significant in price? Okay, these are points. All right, so an inefficiency is the point of deferred balance or deferred rebalance. Okay, deferred rebalance or deferred, sorry, deferred delivery. So what do I mean by deferred rebalance or deferred delivery? It simply means at that point in price, there was no true transaction at that price point. And what occurred during that price point was simply the algo driving the market towards a point of liquidity or inefficiency. So the algo is going to in the future remember those price points as points of deferred delivery. Deferred delivery meaning there was no transaction done around that price point. So it's going to draw the market up there to allow for new delivery or to allow for new repopulation of transactions around that old deferred inefficiency. So let me explain what I mean. Okay. Now with each candlestick, there has to be a corresponding buy or sell transaction going on in the candlestick, right? Let me switch this up, make this a little bit more conspicuous. All right, let's speak on it. Okay, so for a candlestick to form, there has to be an equivalent number of buy or sell transaction going on there. Okay, but there has to be some type of transaction going on there. It could be buy, it could be sell. We don't care. Okay, that's how a candlestick forms. Now, at a point, which is what I call a liquidity base, okay, when there is an influx of orders from a bank terminal, okay, that will kick into effect the interbank algo, which does something called best bid best offer, and that's where you gain efficiency. So what it's doing is it's drawing price artificially. That's different from real transaction. Okay, remember the foreign exchange market is a reflection of true transaction going on in the marketplace. So you have buys and sells coming in at specific price points, and that's what's driving the market. Now, there are going to be points in time whereby there's no buyer sell coming into the marketplace because the market's expanding itself and it's creating inefficiencies. Now, these inefficiencies you're seeing, it could be volume imbalances, fair value gaps, buy side balance, sell side inefficiencies, sell side balance, buy side inefficiencies. These inefficiencies, they are different because they are artificial, meaning they're purely algorithmically driven. They're not a reflection of buy or sell orders. Does it make sense? It is not a true reflection of buy or sell orders. It's all artificial. Okay, so price is being pumped artificially, and then that's what creates the inefficiencies, and that's why they're called deferred delivery. So all inefficiencies, they're called deferred delivery because they're deferred for a later time. So you go Google the word deferred, meaning for a later time. That's what it means. Okay, essentially, meaning for a later time, the market is going to have to revisit those levels for transactional purposes to facilitate transactions at those levels. Now, what is a real balance? A real balance simply deals with a key element, which is a part of the real balance, which is called the gap week. So let me type it out for you guys so you guys understand what I'm saying. It's called the gap week. Okay. And the gap week is something you want to treat as a volume imbalance or a true market gap. So meaning once you spot that wick, you completely ignore the week because that week was artificially driven and it kind of like gapped up. Now, the candlestick is going to print the gap as a high or low, as a week, okay? But in reality, that was the actual market gap, okay? That is what differentiates real balance from the other types of inefficiencies. So let me ask you guys a question so far. Is it making sense? What I'm saying right now, is it making sense? The critical differences between fair value gaps, sell-side values versus inefficiencies, buy-side values, sell-side efficiencies versus rhythm balance is something called a gap week, which I'm going to talk about shortly. Does it make sense so far? Awesome. All right, so I could get one response. I think that's decent. All right, so now let's go into what the redelivery balance is. All right, so there are three types of redelivery balance. We have the standard redelivery balance, we have the advanced redelivery balance, and then we have the auto block redelivery balance. So I'll go into each of them. So the first one is called the standard redelivery balance. Now, if this is a new concept to some of you guys, don't try to implement it immediately in your trading. Okay, with time, you're going to start to see it, and it's going to start to make sense. Okay, standard read-over balance. That's the first one. I'm going to use the line here. Now, in this type of read-over balance, the context here is bullish order flow with a drawn liquidity. That is the context for this first type of read-over balance. So I'm going to use bullish order flow for all the examples. I'm not going to use bearish. I'm going to use bullish. So all you simply do is just invert it for bearishness. Now, in this one, standard read-over balance, you have the market make a buy side or a bullish candle, okay, standard bullish candle, and then the next candle does this. The next candle opens up, straighten up, and then gaps up all of a sudden. Okay, it's trading up, gaps up all of a sudden, and then it quickly pulls back away and closes like this. Now, where it gapped to is what creates the high of that candle. Now, let's say it might have opened, traded lower into the body of this bullish candle, and then you see the gap up, and then it closes like this. And now you have something like this. Now, this is what I call the gap week. This week here is called a gap week, meaning there's no actual volume there. This is a true market gap. So, give me 1 second. Now, what would happen is the next candle is going to open up and then try to rebalance everything. Okay, try to balance this on one side. Now, what you have here is you have an actual market gap. Okay, that the next candle opens up to balance on only the buy side, not the sell side, just the buy side. Okay, and closes like this, right? Trades higher and then closes below, something like this. And then you have your irregular balance. Now, let me bring up the line back here. This is the gap week. And then the next candle opens up and trades third. And then the third candle opens, right? Trades lower into the body of the candle, something like that, and then creates the low of the candle and then expands higher and closes below. And now you have this. Okay, you have the eye of this candle from where it traded up into. That's the eye of the candle. And then you have the low of the candle that trade down into the body of this candle. Now let me explain here. This is a gap. This was only delivered on one side. Now, from the high of this candle to the low of this candle, we only have buy side delivery. Okay, we only have buy side delivery. Now, question: why do we only have buy side delivery from the high of this candle to the low of this candle? Because this was an actual market gap. Okay, if you remove the eye of the wick of that candle, that is a gap that was only balanced on one side. So you want to look at this kind of like a volume imbalance, right? Remember, volume imbalance is there's no lack of buy side or sell side. Now with fair value gap, there's the presence of one side of delivery. Let's say if you have a bearish fair value gap, you only have one-sided delivery, which is bearishness. If you have a bullish fair value gap, you only have one-sided delivery, which is bullishness. If you have a sell side bias by inefficiency, you have again one-sided delivery. Now these are different from volume imbalances where there's no side of delivery. It's neither buy side nor sell side. That's the same thing with delivery balances. The wick, which is what I call the gap wick, okay, is an actual market gap. So this becomes rebalanced on only one side, which is buy side. And then this candle, if this candle trade all the way down to the high of this candle, then that's no longer very balanced. But from the high of this candle all the way to the low of this candle, there's only buy side. There's no sell side. Okay, so going back into this, and this is where you have your standard riddle balance. Does it make sense so far? Let me ask you guys a question before I go into number two. What I mentioned just now, does it make sense? Let me shift this a little bit to the left. I need to get like more replies so I know I'm actually communicating with you guys. If you're struggling understanding concept, if you have any questions, just let me know, and then it will make more sense. So I'm about to jump to the second one, gap weight. All right, awesome. A little, yeah. You're going to have to probably watch it like a couple times for it to make sense. It took me a while for this to make sense. All right, so that is the first one. So this is the standard read over balance. Now remember, for you to identify your read over balance, there has to be the presence of what I call the gap week, which acts like an actual market gap. Like it's gapping into liquidity. All right. So when I'm done with the teaching, I will talk on the immediate rebalances. Immediate rebalances they're the easiest. Okay. Now that is for standard read over balance. Now let's go into example two. So let me clear this off. All right. And then we're going to go into example two, or the second type of redelivered balance. And this is what I call the advanced redelivered rebalance. Okay, this is advanced redelivered balance, and the understanding with this one is similar to the first one. It's just the same thing. The only thing is the nature in which the gap was rebalanced. Okay, remember, redelivered, rebalance. Okay, so again, going back into the name lends understanding into the nature of the candlestick. Okay, a fair value gap that has been traded back into is called redelivery. Does that make sense? So it's being redelivered to a fair value gap. Now, redelivery balance simply means the market is being redelivered to a point of previous deferred delivery, and then it's being rebalanced. I'll make it make sense. Don't worry, I'll make it make sense. So let me do the second example. Second example, also like the first one, you have a candle that opens in a bullish order flow, trades down, making the low of the candle, trades up, and then closes. Okay, or let's say trades up and then closes. This is your all right candlestick high, candlesticks low here, and you're good. And then the next candle opens, trades lower like expected in a bullish order flow, and gaps up, and then closes back below. Then you have your gap wick. Okay, this is your gap wick. This candle trades down to the bottom of the candle. That's your gap wick. And then what the next candle does is the next candle opens, and now unlike the first one, it does not trade above the high of the gap week. Rather, it trades up inside the gap week and then closes below, and then you get this. Okay, and then the next candle comes and then trades completely through all of them, makes the eye, and then closes below, and then you have this. Now, this is your gap week, the one that gaps up into liquidity. That is your gap week. Okay. Now, again, like I mentioned, treat this as null and void. You have nothing here. Okay. Give me 1 second. Man, mix this up. All right. So let me get this straight. From the high of this candle, you have all of this balanced. Okay. And then you have an actual market gap here that the market redelivers on the buy side and then continues to deliver to the upside. Now, this is a gap. Okay. So let me go back and use the object tree. You want to treat the gap week as an actual gap. If that's an actual gap, you have the market open, trades higher, closes back below, and then the next candle opens and then trades through. You have buy side on only one side. It's buy side on only one side, right? Because this is an actual gap. And then this candle opens trades up, trades lower. So just buy side and sell side in the wick of the candle, right? So just buy side and sell side in the wick of the candle because at one point it was a full solid bullish candle and then traded lower and that's sell side. So that is sell side delivery. So from the eye of this candle all the way up to the low, sorry, to the close of this candle, you only have buy side. There's no sell side. That becomes your redelivered rebalance. Excuse me. Now that is different from the other. That's the standard redelivered rebalance because in this example, um, the next candle does not trade through the eye of the gap week. Rather, it trades inside the eye of the gap week. So it's still the same thing. It's just the length or the way the next candle after the gap we created was delivered. And the first one, the next candle after the gap week trades higher above the eye of this candle or above the eye of the gap week. But in the second one, which is the advanced rate of rebalance, the candle does not trade above this. So it's still the same thing. It's just different styles. Okay. Still the same concept, just different styles. Right? So that's the second one, advanced rate of rebalance. Again, hallmark of this is the gap week that gaps into liquidity. Now, when I say the gap week, it always has to gap in direction of order flow. That's how really very balances are. If you're looking at the bearish really very balance, the gap week has to gap down and then close up. That is the bearish really very balance. Okay, so when you're looking at redelivery balances, you're looking at one-sided delivery. It's the nature of a one-sided delivery. So it's kind of like an advanced style of a fair value gap. So you're kind of like bullish fair value gap in this example, right? It's just the nature of the delivery. Fair value gaps don't have gap weeks. Redelivery balances have gap weeks. That's the difference. Does it make sense? And then finally, number three is going to be out of block redelivery balance. Oh man, uh, all of this is just a little bit technical. But what you're going to see is this teaching when you get advanced. Now, this is not going to be like make and break for your price action understanding. It's still okay, but this teaching is going to be extremely important, especially if you want to level up your trading. I mean, when you're doing the HFX entries. So when you're doing 1 minute entries, 30-second entries, these are the things I'm looking at on the chart. And when I do all those from recordings you see on Twitter, and everyone's mind blown, how is he doing all these different things? These are the things I'm doing on those 1 minute time frames that I don't mention to you guys on Twitter that you guys are understanding right now. So that's the foundation to understanding price delivery, or what I like to call the principles of price delivery, which is what Darwin is all about. Principles of price delivery. Okay, number three, order block, read balance, and this is the last final one. It's going to make sense. All right, so if you have a candle, again, the premise here is bullish delivery price. Now, I'm not saying because I'm teaching you this, you automatically want to go incorporate this into your trading. It's going to take you a while. Okay, you have to be patient. It'll take you a while to understand this. It took me months to get this. Okay, and be able to use this. So don't expect too much from yourself. All right. Now, here we have bullish delivery, and then what we have next is we have a down candle, which is kind of like a bearish order block. Sorry, bullish order block. So the candle that makes the river balance is actually a bearish candle. So let me fill this with black. Let's make this. All right. So you have a bearish candle. Again, as usual, you have the gap up into liquidity, and sometimes you can even get a gap down. Okay, and then what happens is the next candle comes and then completely redelivers this. So let's make this white. Yep. Okay. Right. Gaps up, but it's a bullish shadow block, and then what happens next is next candle opens up, trades higher, closes back above, and then you have this. Has to be at the middle. Has to be at the middle. All right, cool. All right, so you have this as your redelivery balance. Now, the difference between this and the first one is the first one is a bullish candle. This one, which is auto block redelivery balance, is a down candle, which technically should be a bullish auto block. But if I see price action like this, I'm not looking at this as a bullish order block. Okay, I'm looking at this as a gap week, and I'm going to take the range from the low of this candle to the high of this candle, and that is my redelivery balance. Okay, because this you want to again you want to treat that as an actual market gap. Okay, this. So if I took away the wick of that candle, you can see there's an actual gap in the marketplace. It's only buy side delivered there. There's no sell side. If I add the wick there, now it looks like a bull shutter block. But I'm not looking at that as a bull shutter block because I'm looking at the gap wick. So that is the difference. All right. So does this make sense? That's the final type of reader rebalance. Before I go answer a question of what immediate rebalances are, does this presentation make sense? Yeah, 1 minute time frame, 30-second time frame, 10-second time frame. That's where I do each of the entries. Yes, I could do on the 1 minute time frame, 30-second time frame, 10-second time frame. Still the same thing. Price action is fractal. That is the basic premise into using all of these time frames. So whatever I'm seeing on the monthly time frame is going to do the same thing on the 10-second time frame, 1 second time frame, all these different type of things. Okay. Do you guys have questions before I go into inventory balances, and then we can do a very quick look at the charts? I saw USD do something wild at the news release. All right, yeah, this is good. You guys have any questions before I go into analysis? Let's watch this fair value gap for any kind of response. All right, it could be good for a long there. Oh, I'm not using what? Nah. Now, for the person who asked me about immediate balance, what I want to do here is I'm going to use an actual live example, which is on USD. So there's an immediate balance here on USD. Context again, bullishness. This is an immediate balance. This is an immediate balance. This is an immediate balance. So immediate balances are when a in a bullish order flow, and this is different from bearish order flow. The moment we create buy side imbalance, sell side inefficiency, or a bullish or a value gap, the next candle, if it trades down and closes in that what would have been an inefficiency, that is immediate rebalance. Now, what's special about immediate rebalances? Immediate rebalances are hallmark of a very strong institutional delivery or interbank delivery, not institutional delivery. It's different from institutional delivery. There's two types of delivery. There's institutional delivery and then there's interbank delivery, or what I like to call interbank sponsorships. The difference here is interbank delivery is the way we deliver price around points of one-sided delivery, or I like to call inefficiencies. Institutional delivery is how we deliver market around consolidations, order blocks, breaker blocks. All those are all institutional delivery. Okay, interbank delivery is inefficiencies. Okay, because interbank traders will pile on inside points of inefficiencies to deliver the market to a point of liquidity. Okay, that's what we're seeing on this one, which is evidence of a strong institutional delivery. So now we have a liquidity up here. Once I see this, let's say I took an entry off of this as a bullshit ball, right? Market shares up into this and expands. Once this next candle opens, okay, because remember, at the time of my entry, let's say I took an entry off of this as a bullshit ball. At the time of my entry, this is a potential inefficiency being created. The moment I see a candle open, trades down there, look at what I'm talking about, right? It opens, trades as a bearish candle, and then immediately trades above. I become extremely confident of my trade, and I know I'm not going to spend time waiting for the market to get up into liquidity because that is classic price delivery. Once you see this, that to me is all interbank sponsorship. It's interbank sponsorship in my buy or in my execution. And what you're going to see next is the market will spend no time reaching up into liquidity because you can see it gave you evidences with immediate rebalance. So that is what's special about immediate rebalances. Whenever I'm on a trade, I'm looking for immediate rebalances. Once I spot immediate rebalances, go and watch the live executions we do. So the recordings of the New York session trades. Every time I mention the immediate rebalance, watch how a little bit excited I get because I already know what's bound to happen next, right? Because I know almost surely how that trade is going to pan out once I see zero balances in the direction of my executions. So that's what's different between zero balances versus redelivered balances. Hopefully it makes sense. This makes sense. They're not similar in principle. Redelivered balance is a form of deferred delivery. Immediate rebalance is not a deferred delivery. Okay, all inefficiencies are a form of deferred delivery, meaning delivery for a later time. Immediate rebalances are immediate delivery, so it's immediately rebalanced. Okay, what would have been a deferred delivery is immediately rebalanced. This would have been a bullish fair value gap, but it's immediately rebalanced. This would have been a bullish fair value gap, but it's immediately rebalanced. This would have been a bullish for value gap, but it's not immediately balanced, so that makes this a deferred delivery, delivery for a later time. That's the difference. Doesn't make sense. C, awesome. All right, let me start the recording here, and we can